Welcome to today's economic analysis. I'm your host, and we're diving into a critical situation affecting American wallets and the global economy. The U.S. economy is showing serious warning signs, and today we're examining why Trump's tariff policies have created such unprecedented market turmoil. What's concerning is how this crisis has expanded beyond stock market volatility. It's now threatening the broader economic landscape in ways experts didn't anticipate. Let's break down why these tariffs are different from historical trade measures. When governments implement tariffs, markets typically adjust without major disruption. For example, automotive tariffs might increase domestic car prices and inconvenience consumers, but they generally don't trigger widespread market panic. Traditional economic theory suggests that when consumers pay more for domestic products instead of imported ones, that money stays within the national economy. Domestic manufacturers receive these funds and can reinvest them, potentially creating jobs and spurring local growth. However, what we're seeing now is fundamentally different. The market's severe reaction to Trump's tariff policies suggests deeper structural concerns. International investors, who traditionally view the U.S. as a safe haven, are showing unprecedented anxiety. This has triggered a chain reaction affecting stocks, bonds, currency markets, and international trade relationships. The key distinction is the scale and scope of these tariffs. Unlike targeted measures of the past, the current policies have created widespread uncertainty rippling through multiple sectors. When combined with existing economic pressures and global political tensions, particularly in regions like the former Soviet territories and emerging markets, you get a perfect storm of economic instability. Remember to subscribe to stay informed about these crucial economic developments. In our next segment, we'll explore how these tariffs affect your retirement accounts and what you can do to protect your investments. Good evening. I'm bringing you critical economic news that affects every American's wallet. In a dramatic shift from traditional trade policies, former President Trump's sweeping tariff strategy has created what experts call unprecedented economic uncertainty. Trump's approach implements a broad 10% tariff across all imports, with higher rates for major trading partners. This has raised America's average tariff rate to 23%, 6 times higher than last year, and the highest level in over a century. Economic analysts warn that these universal tariffs could have a boomerang effect on American businesses. While targeted tariffs might shield specific industries from competition, these blanket tariffs are driving up costs for all imported components, making American manufacturers less competitive globally. What's concerning for business leaders and investors is the uncertainty surrounding these tariffs. Markets hate uncertainty, and there's no clear indication of how long these measures will stay or how trading partners might respond. This creates challenges for businesses planning operations and investments. When companies can't predict costs or market access, they become more cautious with investments and hiring. This ripple effect could slow economic growth and impact jobs across sectors. Consider a typical American manufacturer relying on imported components. While they previously focused on efficiency and quality, they now must navigate the most complex tariff environment in modern American history. This affects both large corporations and small businesses, with smaller companies particularly vulnerable to increased costs. Some economists argue that while tariffs might appear to protect American interests, the current approach could weaken our competitive position in global markets. The question remains: will these measures achieve their intended goals, or are we witnessing a fundamental restructuring of American trade policy with unforeseen consequences? Let's break down what this means for your wallet and the nation's economy. The uncertainty created by current trade policies is having a chilling effect on both business investment and consumer spending. When businesses aren't sure what's coming next, they're more likely to hold on to their cash rather than invest in new projects or hire more workers. What's particularly concerning is how this affects President Trump's stated goal of bringing manufacturing back to American soil. Such a massive undertaking would require trillions in investment, something increasingly unlikely in an uncertain environment. The numbers paint a sobering picture. Goldman Sachs has dramatically revised their recession probability estimates from 20% a month ago to suggesting a recession is more likely than not if the proposed tariffs take full effect. Popular betting markets like Polymarket and Kalshi are even more pessimistic, putting the odds above 60%. The stock market has responded accordingly. The S&P 500 has plummeted roughly 20% from its February peak. we're seeing wild swings in market values, creating a roller coaster effect that's making investors increasingly nervous. While some might dismiss stock market performance as disconnected from the real economy, there's a crucial detail. Our current economic structure heavily depends on spending from the wealthiest 10% of Americans, who account for half of all consumer spending. When their investments take a hit, the ripple effects are felt throughout the entire economy. This situation underscores a fundamental vulnerability in our economic system, one that could have far-reaching consequences for all Americans. In a concerning development for financial markets, we're witnessing an unusual phenomenon that's raising red flags among economic experts. Traditional market wisdom is being turned on its head as both stocks and government bonds face simultaneous selling pressure, creating what analysts are calling a perfect storm of market instability. Normally, when the stock market takes a hit, investors flee to the safety of U.S. Treasury bonds. It's like moving your money from a risky business venture into a secure savings account. But something different and potentially dangerous is happening now. Monday's trading saw an extraordinary jump in 10-year Treasury yields, climbing from 3.9% to 4.2%. A massive single-day movement that has market veterans worried. When yields go up, bond prices go down, indicating that investors are selling these traditionally safe assets. This creates a double-edged sword for the administration. First, it suggests that global investors are losing confidence in the U.S. as a safe haven. Second, it puts additional pressure on America's already strained fiscal situation. The wealthy, who typically drive significant consumer spending and are more sensitive to stock market fluctuations, are likely to pull back on expenditures. This could accelerate any economic slowdown, creating a feedback loop that further destabilizes markets. What's particularly troubling is that it breaks from historical patterns. Traditional safe harbors are no longer functioning as expected, leaving investors with fewer options for protecting their wealth during market turbulence. This unusual market behavior suggests deeper structural issues in the economy that may not be easily addressed through conventional measures. The simultaneous decline in both stocks and bonds represents a significant vote of no confidence in current economic conditions and policy directions. As yields rise, the cost of government borrowing increases, potentially limiting fiscal options when they might be most needed. Breaking news on the alarming state of America's federal finances and economic outlook. Financial analysts are sounding urgent warnings about the nation's mounting debt crisis, with federal debt now towering at approximately 120% of GDP, while running a staggering deficit of around 6%. Economic experts are particularly concerned about Donald Trump's proposed economic policies, which include substantial tax cuts without corresponding spending reductions. This approach threatens to further destabilize an already precarious fiscal situation. While these tax cuts might appear attractive to voters, they could potentially trigger a cascade of negative economic consequences. The traditional safety nets of the American economy are showing signs of strain. Treasury yields, historically considered recession-proof assets, are experiencing unusual volatility. This shift signals a fundamental change in how investors view U.S. government debt, raising red flags about America's long-term financial stability. Perhaps most surprisingly, the U.S. dollar, long considered a global safe haven during times of economic uncertainty, isn't behaving as expected. Despite Trump's aggressive tariff policies, which theoretically should strengthen the dollar by weakening America's trading partners' currencies, we're seeing unexpected patterns in currency markets. Financial experts are drawing parallels to situations seen in less stable economies, warning that if the U.S. enters a recession while maintaining high Treasury yields, we could face an unprecedented debt crisis. The combination of reduced tax revenues during a potential downturn and persistent high borrowing costs could create a perfect storm for American finances. The situation becomes even more complex when considering the global trade landscape. While tariffs were intended to protect American interests, their implementation appears to be having unintended consequences on both domestic and international markets. This developing story raises serious questions about the sustainability of current fiscal policies and their long-term implications for American economic stability. Looking at recent financial indicators, the dollar's performance against major global currencies has shown a concerning downward trend over the past months. This development carries significant implications for the American economy, and raises red flags about international confidence in U.S. currency markets. Market analysts are troubled by this trend for two reasons. First, the weakening dollar suggests eroding global trust in American economic stability. Second, this decline threatens to accelerate inflationary pressures. Initially, experts believed Trump's tariff policies could avoid major inflationary consequences. The theory was that price increases from trade friction would be offset by a stronger dollar, making imports more affordable. However, this assumption is now challenged by current market realities. With the dollar losing ground, we're facing a potentially dangerous economic scenario. The combination of tariffs and a weakening currency could create a perfect storm for inflation. Financial analysts project inflation rates could surge to around 5%, significantly impacting American consumers' purchasing power. This situation appears to be setting the stage for a confrontation between the White House and the Federal Reserve. While Trump advocates for interest rate reductions to boost economic growth, the Federal Reserve may need to maintain rates or implement increases to combat rising inflation. The possibility of Trump challenging the Fed's authority seems increasingly plausible, which has market observers nervous. This potential power struggle could introduce additional uncertainty into an already volatile economic environment. These developments are especially significant when considered alongside ongoing trade tensions with major partners like China and the former Soviet Republic. The complex interplay of these factors suggests we're entering a period of heightened economic uncertainty, where traditional policy responses may be tested in unprecedented ways. In an era where headlines seem increasingly surreal, financial experts warn we could be heading toward the most severe crisis of confidence in modern history. This isn't just another market fluctuation. It's a perfect storm brewing at the intersection of geopolitical upheaval and domestic political chaos. Speaking of chaos, let's talk about the circus that modern American politics has become. While we haven't quite reached the point of declaring war on Jupiter, though given recent events, would anyone be truly surprised? We're witnessing some genuinely bizarre moments that deserve our attention. Take Elon Musk, for instance, who's recently taken to labeling his critics as terrorists, while simultaneously trying to manage Tesla's mounting challenges. It's like watching a tech CEO play whack-a-mole with public relations disasters, except the mole keeps multiplying. For those trying to make sense of this peculiar political landscape, our series WTF USA offers a refreshingly candid look at American politics. Unlike our traditional news coverage, this series takes a more lighthearted approach to examining the implications of social media explosions and cultural phenomena on our political system. The series, available exclusively on Nebula, joins other thought-provoking content like Tom Nicholas's Boomers, a deep dive into pressing issues facing different generations. From housing crises to pension concerns, climate challenges to economic inequality, it's becoming clear that these aren't just isolated problems, but interconnected challenges requiring comprehensive solutions. As we navigate through these turbulent times, with the former Soviet Republic crisis ongoing and international alliances being tested, it's crucial to maintain perspective while staying informed. The news cycle might seem overwhelming, but understanding these events' broader implications helps us prepare for whatever comes next. Remember, in times of uncertainty, reliable information becomes more valuable than ever. Stay tuned as we continue to monitor these developments and their potential impact on both domestic and international fronts. In today's analysis, we're examining a cultural phenomenon reshaping how Americans consume news and entertainment. As your trusted source, we're exploring two significant developments capturing our mature audience's attention. First, let's address the groundbreaking documentary examining the baby boomer generation's legacy, a topic resonating with many of our listeners who witnessed these transformative decades firsthand. In an era of evolving media, we're seeing a shift in content delivery. Nebula, a new streaming platform owned by content creators, is making waves. This isn't typical streaming. It's becoming a hub for intellectual programming. What sets this platform apart is its roster of respected content producers, including Real Life Law, Wendover Productions, Legal Eagle, and Neo. These channels provide substantial, well-researched content our discerning listeners might value. A key feature is Nebula's ad-free experience. In today's media landscape, where advertisements interrupt frequently, this is refreshing. Subscribers also get early access to content before it appears elsewhere, including YouTube. There's currently a special offer making it accessible. A 40% discount brings the annual subscription to $36 or about $3 monthly, less than a coffee. This development represents a shift in how serious news and educational content is consumed, particularly among viewers who appreciate in-depth analysis and thoughtful programming. It shows there's always room for innovative approaches to delivering quality information. Remember, staying informed doesn't have to feel burdensome. Sometimes, it's about finding the right balance between analysis and engaging presentation. This platform seems to achieve that balance effectively.